Hey everyone, Akasha here, and today we are diving into something that genuinely keeps me up at night in the best possible way. I remember sitting on a trading floor back in 2012, watching these massive server racks humming away, processing millions of orders per second, and thinking, this is the pinnacle of speed. Nobody can go faster than this. Well, I was wrong. Spectacularly, beautifully wrong. Because what quantum computing is doing to high-frequency trading right now is not just an upgrade. It is a complete and total reinvention of the game. So grab your coffee, settle in, because we are going deep today. Let me break this down without the PhD jargon, because honestly, that is how I had to learn it myself. Classical computers, the ones running every trading system you have ever seen, work in bits. Zeros and ones. On or off. Every calculation is a sequence of those binary decisions. Now, quantum computers use something called qubits. And here is where it gets wild. A qubit can exist as a 0, a 1, or both simultaneously, thanks to a property called superposition. On top of that, you have entanglement, where qubits become linked so that the state of one instantly influences another, regardless of distance. What this means practically is that a quantum computer does not work through problems one path at a time. It explores thousands, potentially millions of pathways at once. For high-frequency trading, where firms are executing anywhere from tens of thousands to over 1 million trades per second, the optimization problems involved are staggering. Route selection, portfolio rebalancing, arbitrage identification, risk calculation, these are all problems that quantum systems are uniquely positioned to obliterate in terms of speed and accuracy. IBM currently has operational quantum processors exceeding 1,000 qubits. Google announced their Sycamore processor completed a specific calculation in 200 seconds that they claimed would take a classical supercomputer approximately 10,000 years. Now, that specific benchmark has been debated, but the directional truth is undeniable. The computational gap is enormous and it is widening every single year. Here is what I find fascinating, and what most mainstream financial media is completely sleeping on. The biggest players in high-frequency trading are not waiting for quantum computing to mature. They are funding the research themselves. Citadel Securities, one of the most dominant market makers on the planet, handling roughly 25% of all U.S. equity trading volume on any given day, has been quietly building quantum research partnerships. Vertu Financial, another HFT giant, has been public about exploring quantum optimization for their execution strategies. JP Morgan Chase published an actual research paper. I read the whole thing. It is dense but worth it, demonstrating how quantum algorithms could improve options pricing models by orders of magnitude. Goldman Sachs has filed patents related to quantum computing applications in derivatives trading. These are not speculative future plans. These are active, funded, strategic initiatives happening right now. And then there is D-Wave Systems, a Canadian company that has been selling what they call quantum annealing computers since 2011. Their systems are specifically designed for optimization problems, finding the best solution among an almost incomprehensible number of possibilities. Volkswagen used D-Wave technology to optimize traffic flow. But financial firms have been using similar quantum annealing approaches to optimize portfolio construction and minimize slippage in large order execution. In my experience tracking these developments, the firms that dismiss this as science fiction are the same firms that dismissed algorithmic trading back in 2003. And we all know how that story ended. Let me put some numbers on the table here because context matters enormously. Today, the fastest classical HFT systems operate at latency speeds measured in nanoseconds. 1 nanosecond is 1/1,000,000th of a second. Firms like Jump Trading and Tower Research Capital spend hundreds of millions of dollars on fiber optic infrastructure, microwave towers, and colocation services just to shave microseconds off their execution times. The colocation business alone, where firms literally place their servers inside exchange buildings, generates billions in annual revenue for exchanges like NYSE and NASDAQ. Quantum computing does not just improve on these speeds incrementally. It changes the nature of the computation itself. Consider portfolio optimization, finding the ideal combination of thousands of assets given constraints like risk tolerance, liquidity, and correlation. A classical computer solves this sequentially, testing combinations methodically. A quantum computer using what is called the quantum approximate optimization algorithm, or QAOA, can evaluate the solution landscape in a fundamentally different way. Research from firms including Barclays and 1QBit, a quantum software company, demonstrated that quantum approaches to portfolio optimization could reduce computation time for complex multi-asset problems from hours to seconds. Now imagine that capability applied to real-time risk management during a flash crash event. In May 2010, the Dow Jones dropped nearly 1,000 points in minutes before recovering. Many HFT firms shut down entirely because their risk systems could not process fast enough to make sound decisions. Quantum-enhanced risk systems would change that calculus.